You have questions, we have answers. Back with another quick clip. We had a question that came through. This individual owns real estate, invests in real estate to some degree, and they've just recently heard of 1031 exchanges, and they're relatively new to the field of real estate. Can you talk to us a little bit about what 1031 exchanges are and how that might be beneficial?
Absolutely, Brian. So definitely something that's come up a ton in the last few years, pretty much nationwide because of the boom that we're seeing in real estate in general. So Cliff Notes version, basically Section 1031 of the Internal Revenue Code basically deals with the ability of an investor to defer taxable gain on the sale of an investment property as long as they take that gain and all cash proceeds and put it into another real investment property. Basically just allows for real estate professionals and regular people who own real estate to defer any taxable gain they have on that as long as they put it into another real investment. So definitely can be something that is part of the overall financial planning process. It's something that does have a lot of rules, and you kind of have to make sure you get them all correct in order to do a correct exchange. So, definitely some very, very competent tax and professional help is warranted. But at the same time, it's not, absolutely complex and something to be scared of. So my example that I use that's kind of corny, but is really, true is, selling a $5 million apartment building or a piece of real estate is a lot more complex than pushing a button and selling $5 million worth of Amazon stock. So you want to get it right and make sure you know what you're doing, but it's definitely something that any investor can do with a little help.
So David, what are maybe just a couple of these rules, maybe the Cliff Notes version, just to give people an idea?
Sure. So there's 6 big things that you have to get right, okay? So number one, whatever you're selling and whatever you're buying has to be what's considered or known as like kind. So like kind does not mean exactly the same. So in other words, it doesn't have to be something you're selling on the same street or even in the same state, or it can be a building versus a warehouse or whatever, or a piece of land, whatever it is. It just has to be investment property for the most part. Again, this is where professional tax help can really come in and be a big deal. You have to use a qualified intermediary, which is number 2. Basically, all a qualified intermediary is an escrow company that specializes in doing 1031 exchanges. Key thing here is that you never touch the funds. It goes straight to the QI and then into the new investment property. Numbers 3 and 4 are 2 time frames that you have to get right. Basically, there's a 45-day identification period. So that starts when you sell your old property, and 45 days from that date, you have to say, hey, here's what we're buying, or here's what I'm buying. The other part is there's a 180-day purchase period. So from that same time frame, when you sell the old property, you basically have 6 months to get the new deal done. So those 2 windows are critical, and you got to get them, you have to be within those 2 windows. Number 4 is what's referred to as the mirror image title rule. So essentially, if you and your spouse own the old property, you and only your spouse have to be on the title on whatever's being bought. Same thing as, let's say, if your LLC owns the old property, only your LLC can be the one that's purchasing. It has to be exactly the same on both sides. And then the final thing is in regards to making sure you get complete full deferral of your full taxable amount, whatever that is. You need to make sure you defer 100% of the net cash proceeds. Those are really the big things, and that's kind of a real highlighted version of it.
Sure.
Dig in, there's a lot under the hood, but those are the real major things.
Yeah, so there's a lot that's there. So measure twice, cut once, make sure that you know exactly what you're getting yourself into. As it relates to, you said, obviously real estate, buildings, land, maybe a warehouse. Any other assets that we should be aware of as it relates to 1031 exchanges and what we might be able to do?
Yeah, no, there absolutely are. And, this is something, again, that's come up a lot recently. The example I give is, a real estate professional who might be retiring or getting out of the landlord business, as I say. So, in that case, you're looking for a passive vehicle. There are some passive investment vehicles that are out there that do qualify for 1031 exchange treatment. The major one that investors would come across nowadays is what's referred to as a Delaware Statutory Trust, or DST. So what a DST is simply a legal structure or legal investment structure set up for the sole purpose of allowing investors, access to passive vehicles that do qualify for 1031 exchange treatment. Technically, you can't say, well, it's just like a REIT, but for a basic understanding, that's a great place to start. It's like buying a REIT that does qualify for 1031 exchange treatment. There's a lot of good things about DSTs, and then there's some things that you definitely want to think of before jumping in. So number one, they're passive vehicles. They allow you to have that money invested for you, and they're usually very income oriented. So when you look at retirement income planning, or you look at the main reason why most people are doing real estate is to generate income,
Sure.
it's a great way to do that. Another thing that is a big deal is that typically the way DSTs are set up, they will allow the average individual investor access to real estate investments that they might not otherwise have any access to. So those are all kind of some of the really, really good things. Some of the things to think about, typically DSTs are private equity, okay? So they're illiquid. You can't buy them in February and then say in July, goodness, I want out of this thing. That's pretty much not how it works. So when you do buy it, you're buying it for the life of the trust, which is typically as long as the buildings are owned. So it's a long-term thing. The other thing that I think comes up quite frequently, especially with real estate professionals, they might have been doing a great job managing their portfolio of real estate their whole life, and they've done a great job. When they turn the money over, they're not running it anymore.
Yeah,
so the passive nature is a really, really great thing, but it's also psychologically something you got to know, hey, I'm not the boss anymore. Someone's doing it for me.
David, thank you very much. I know it's a difficult topic, but it's a great question to have, and I think a lot of people can learn from it, those who are involved in real estate or interested in learning more about it. So I greatly appreciate your time, and thanks for being here today. Thanks
so much, Brian. Take care.
If anyone's watching this or any of the other videos and they have questions they'd like answers to, please feel free to email us at qa@marinwealthadvisors.com. Thanks for watching.